Welcome to the Mind Budget. Have you ever heard the phrase time is money? Well, when it comes to investing, that saying couldn't be more true. Today, we're talking about one of the most powerful tools in the world of finance, compound interest. It's the force that can turn a small investment into a sizable nest egg over time. But how exactly does compound interest work, and how can you take advantage of it to reach your financial goals? Stay tuned to find out. Compound interest is a financial concept that refers to the interest earned on the initial principal of an investment, as well as any interest that has been previously earned on that principal. In other words, it's interest on top of interest. The power of compound interest lies in its ability to accelerate the growth of your money over time. When you earn compound interest, your investment grows not only from the original amount you put in but also from the interest that accumulates on that amount. This means that over time, your investment can grow exponentially, as the interest earned on your investment itself earns interest. Compound interest can be earned on a variety of investments, including savings accounts, certificates of deposit, CDs, bonds, and mutual funds. The rate of compound interest you earn can vary depending on the investment vehicle and the interest rate offered. The frequency of compounding can also vary, with some investments compounding interest daily, monthly, quarterly, or annually. Understanding compound interest is essential for building wealth and achieving your long-term financial goals. With the power of compounding on your side, even a small amount of savings or investment can grow significantly over time, making it an incredibly valuable financial tool. Compound interest is a powerful tool that can help you grow your money over time. Here are the basics of how compound interest works. Initial principal: when you make an investment, you start with an initial principal amount. This can be any amount of money, depending on the investment you choose. Interest rate: the interest rate is the amount of money you earn on your investment over a set period of time, typically expressed as a percentage. The interest rate can vary depending on the investment you choose and the market conditions. Compounding period: the compounding period is the frequency at which interest is added to your initial investment. For example, if you have an investment that compounds monthly, the interest is added to your account balance every month. Calculation of interest: with compound interest, the interest earned on your investment is added to your account balance, and then interest is calculated on the new, higher balance. This means that your investment grows not only from the initial principal but also from the interest earned on that principal. Growth over time: as you continue to earn compound interest, your investment grows exponentially over time. The longer you keep your money invested, the more time it has to compound and grow. Risk and return: it's important to remember that compound interest is not a guarantee of returns. Different investments come with different levels of risk and return, and it's important to choose investments that align with your financial goals and risk tolerance. Understanding the basics of compound interest can help you make informed decisions about your investments and set yourself up for long-term financial success. By starting early and taking advantage of the power of compounding, even small investments can grow into significant sums over time. The difference between simple and compound interest lies in how interest is calculated on an investment. Here's what you need to know. Simple interest: with simple interest, interest is calculated only on the initial principal amount of your investment. For example, if you invest $1,000 at a simple interest rate of 5%, you would earn $50 in interest per year. This is calculated as 5% of the initial $1,000 investment. Compound interest: with compound interest, interest is calculated not only on the initial principal amount but also on any accumulated interest that has been earned. For example, if you invest $1,000 at a compound interest rate of 5%, the interest earned in the first year would be $50. In the second year, however, interest would be calculated not only on the initial $1,000 but also on the $50 of interest earned in the first year. This means that the interest earned in the second year would be slightly higher, and the interest earned in each subsequent year would continue to grow. The key difference between simple and compound interest is the way in which interest is calculated and added to your investment. With simple interest, you earn a fixed percentage of your initial investment each year, while with compound interest, your investment grows exponentially over time as interest is added to the principal and continues to earn interest. In general, compound interest tends to be more advantageous for investors because it allows for greater growth of their money over time. However, it's important to carefully consider the interest rate and compounding period when choosing an investment, as well as any fees or other costs associated with the investment. The power of compound interest lies in its ability to grow your money exponentially over time. Here's how compound interest can work for you over different time periods. Short term: even in the short term, compound interest can have a significant impact on your investment. For example, if you invest $10,000 at a compound interest rate of 5% for 1 year, your investment will grow to $10,500. However, if you instead earn simple interest on the same investment, you would only earn $500 in interest. Medium term, over a longer time period, such as 10 years, the power of compound interest becomes even more apparent. Using the same example as above, if you invest $10,000 at a compound interest rate of 5% for 10 years, your investment will grow to $16,386. On the other hand, if you earn simple interest on the same investment, you would only earn $5,000 in interest over the same time period. Long term, the real power of compound interest is seen over long time horizons, such as 20, 30, or even 40 years. For example, if you invest $10,000 at a compound interest rate of 5% for 30 years, your investment will grow to $43,219. However, if you earn simple interest on the same investment over the same time period, you would only earn $15,000 in interest. As you can see, the longer you keep your money invested, the more significant the impact of compound interest on your investment becomes. Even a small difference in interest rates or compounding periods can lead to large differences in your investment returns over time. It's important to start investing early and take advantage of the power of compound interest to achieve your long-term financial goals. By investing regularly and staying invested over the long term, you can harness the power of compound interest to build significant wealth over time. Here are a few examples of compound interest in action to help illustrate its power. Retirement savings. One of the most common examples of compound interest is retirement savings. Let's say you start investing $5,000 per year in a retirement account at age 25 and continue doing so until you reach age 65. Assuming an average annual return of 7%, your investment would grow to over $1.2 million by the time you reach retirement age. Credit card debt. Compound interest also works against you when it comes to credit card debt. If you carry a balance on your credit card and only make minimum payments, interest will accrue on the balance and continue to compound over time. This means you end up paying significantly more in interest charges over the life of the debt than you would if you paid off the balance in full each month. Mortgage payments. Another example of compound interest is seen in mortgage payments. When you take out a mortgage, you're essentially borrowing a large sum of money that you'll pay back over time with interest. Because mortgage loans are typically amortized over 30 years, interest accrues over time and is compounded monthly. This means you end up paying much more in interest charges over the life of the loan than you would if you paid cash for your home. Investment returns. Finally, compound interest also applies to investment returns. When you invest your money, you earn returns on your principal investment. Over time, those returns compound, meaning you earn interest on the interest you've already earned. This can lead to significant growth in your investment portfolio over time, especially if you stay invested for the long term. Compound interest can work for or against you depending on how you use it. By harnessing the power of compound interest through smart investing and avoiding high interest debt, you can put this financial principle to work for you and build significant wealth over time. If you want to take advantage of the power of compound interest to build wealth over time, here are some strategies that can help. Start early. The earlier you start investing, the more time your money has to compound and grow. Even small amounts invested early on can have a significant impact on your long-term wealth. Be consistent. Consistency is key when it comes to investing for the long term. Set up regular contributions to your investment accounts, whether it's weekly, monthly, or quarterly, and stick to your plan. Invest in growth assets. Investing in assets that are likely to grow over time, such as stocks and real estate, can help maximize the benefits of compound interest. These assets tend to provide higher returns over the long term, which can help your money grow faster. Reinvest your returns. When you earn returns on your investments, whether it's through dividends, interest, or capital gains, reinvesting those returns can help maximize the power of compound interest. By reinvesting your returns, you'll be earning returns on your returns, which can lead to exponential growth over time. Avoid high interest debt. Compound interest can work against you when it comes to high interest debt, such as credit cards and payday loans. By avoiding these types of debt and paying off your balances in full each month, you can keep more of your money working for you through investments that earn higher rates of return. Consider a tax-advantaged account. Investing in tax-advantaged accounts, such as 401ks and IRAs, can help maximize the power of compound interest by allowing your investments to grow tax-free or tax-deferred. This means you'll keep more of your investment returns working for you over the long term. By following these strategies, you can harness the power of compound interest to build significant wealth over time. The key is to start early, be consistent, and stay invested for the long term. With time, patience, and smart investment decisions, you can put compound interest to work for you and achieve your financial goals. While compound interest can be a powerful tool for building wealth over time, there are also risks and limitations that you should be aware of. Here are a few to consider. Market risk. When you invest your money, there is always a risk that the market will experience a downturn, leading to a decline in the value of your investments. This can impact the amount of compound interest you earn over time and can even result in losses. Inflation risk. Inflation can erode the purchasing power of your money over time, reducing the value of your investment returns. This means that while your investments may be growing through compound interest, their actual purchasing power may be decreasing. Taxes and fees. Taxes and fees can eat into your investment returns over time, reducing the amount of compound interest you earn. It's important to factor in these costs when considering the potential returns of your investments. Limited availability. Compound interest is not available in all types of investments or accounts. For example, savings accounts and CDs often offer compound interest, while other types of investments, such as bonds, may not. Not a guaranteed return. While compound interest can lead to significant growth over time, it's important to remember that it's not a guaranteed return. Investment returns can vary based on market conditions, and there is always a risk of loss when investing. Overall, it's important to understand the risks and limitations of compound interest when making investment decisions. By factoring in these considerations and taking a balanced approach to invest, you can harness the power of compound interest while managing the risks and limitations associated with it. If you're just getting started with investing and want to take advantage of the power of compound interest, here are a few tips to help you get started. Start small. You don't need a lot of money to get started with investing in compound interest. Start with what you can afford and focus on consistency over time. Educate yourself. Before you start investing, take the time to educate yourself about different types of investments, risk management, and the power of compound interest. There are many resources available online, at your local library, or through financial advisors. Set a goal. Setting a financial goal can help you stay motivated and focused on the long term. Whether you're saving for a down payment on a home, building an emergency fund, or planning for retirement, having a goal in mind can help you stay on track. Consider your risk tolerance. Before investing, consider your risk tolerance and invest in assets that align with your goals and risk tolerance. Generally, investments that offer higher potential returns also come with higher risks. Diversify your investments. Diversifying your investments across different asset classes can help manage risk and maximize the benefits of compound interest over time. Use tax-advantaged accounts. Take advantage of tax-advantaged accounts such as IRAs, 401ks, or 529 plans to maximize the benefits of compound interest and minimize taxes. Stay the course. Investing is a long-term game, and it's important to stay invested and avoid making rash decisions based on short-term market movements. Sticking to your plan and avoiding emotional reactions to market fluctuations is key to long-term investment success. By following these tips, you can get started with investing and take advantage of the power of compound interest to build wealth over time. Remember, investing is a long-term game, and consistent, disciplined investing over time is the key to achieving your financial goals. Compound interest is a powerful tool that can help you build wealth and achieve your financial goals over time. By earning interest on your initial investment as well as the interest earned over time, you can benefit from exponential growth and significant returns. The power of compound interest lies in the fact that it rewards consistency, time, and patience. Even small contributions made consistently over time can grow significantly through the power of compound interest. By starting early and allowing your investments to grow and compound over time, you can maximize the benefits of compound interest and set yourself up for financial success in the future. Whether you're saving for a down payment on a home, planning for retirement, or simply looking to grow your wealth, compound interest can play a key role in achieving your financial goals. By following sound investment strategies, staying disciplined, and being patient, you can harness the power of compound interest and build a secure financial future for yourself and your family. Thank you for watching this video on the power of compound interest. We hope you found it informative and helpful in understanding how compound interest can help you achieve your financial goals over time. Remember, the key to maximizing the benefits of compound interest is to start early, stay consistent, and invest in a diversified portfolio aligned with your goals and risk tolerance. If you enjoyed this video, please like, share, and subscribe to our channel for more informative content on personal finance and investing. And as always, please do your own research and seek the advice of a qualified financial advisor before making any investment decisions. Thanks again for watching, and we'll see you in the next video.